Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate gobbledygook and find the real stories hidden within. Today we're diving into NeOnc Technologies Holdings and their latest filing, which looks like it might be a little interesting. Let's just say it involves some borrowed money and some fast-moving deadlines. Before we jump in, if you appreciate getting straight, no-nonsense insights from these corporate documents, make sure you're subscribed to the channel. We also have a Discord community linked down in the description where we break down even more of these filings and discuss them as a group. So we're looking at NeOnc Technologies Holdings Inc. If you're not familiar, they're a company operating in the biotech or healthcare space, aiming to make a splash in a pretty competitive field. Now, the heart of this report is about a couple of deals NeOnc made back in July. Basically, they entered into agreements to sell what are called convertible promissory notes. Think of these like IOUs, but with a twist. The company issued these notes to investors to the tune of $5 million. That's a significant chunk of change, and it tells us they needed funding, likely to keep their operations going or to invest in new projects. Here's where it gets a bit more complex, but also more interesting. These notes came with a 20% original issue discount. What does that mean? It means that for every $100 in face value of these notes, the investors only paid $80. So NeOnc received less cash up front for the full amount they promised to pay back. This discount is basically the investor's way of getting a higher potential return for taking on the risk, especially with a company that might be considered newer or less established. It's like buying something on sale, but the sale is built into the price they pay to borrow. And that twist we mentioned, these notes are convertible. This means that instead of just getting their money back plus interest, the investors have the option to trade these notes in for shares of NeOnc's common stock. This is a pretty common feature in deals with growing companies. If the company does well and its stock price goes up, the investors can convert their notes into stock and potentially make a lot more money than they would have just by getting their principal back. Now let's talk about how that conversion price is set. It's tied to the company's stock price. The investors can convert their notes into stock at 80% of the lowest closing price the stock hit in the 5 trading days before they decide to convert. This is a pretty aggressive conversion price for the investors. It means they're getting a discount on the stock price itself when they convert. Companies often do this to incentivize investors, but it can also mean a lot of dilution for existing shareholders if the stock price is low and many investors convert their notes. Dilution means that the ownership incentivizes investors, but it can also mean a lot of dilution for existing shareholders if the stock price is low and many investors convert their notes. Dilution means that the ownership percentage of each existing share decreases because more shares are issued. These notes have maturity dates in October, but the company has the option to extend these dates. However, each 1-month extension comes with an additional 5% added to that original issue discount. So if they need more time, it's going to cost them more, making those notes even more expensive down the line. This suggests NeOnc might be facing some cash flow pressures or is planning for scenarios where they might need that flexibility. These deals mean NeOnc has entered into what are called material definitive agreements. Essentially, these are important contracts that have a significant impact on the company's financial standing and future operations. This filing also highlights that the company is creating a direct financial obligation. That's the $5 million plus whatever interest or discounts pile on later. They're on the hook for this money. And because these notes are convertible into stock and likely offered directly to these investors without a public offering, this falls under unregistered sales of equity securities. Looking at the exhibits, we can see the actual forms of these agreements, the notes themselves and the purchase agreements. This is where all the nitty-gritty details would be if you really wanted to deep dive into the legal terms. The company's stock is pretty standard with a par value of a very small amount, 0.00001 per share. This is common in the US for common stock. Their trading symbol is NTA, listed on the Nasdaq Stock Market LLC. This is the public face of the company where investors buy and sell shares. NeOnc has also checked the box indicating they are an emerging growth company. This is the designation that allows companies to take advantage of certain flexibilities in complying with new financial accounting standards, meaning they might not have to adopt the latest, most complex rules right away. It's a common status for companies that are still growing and developing. Now let's zoom out a bit and think about what this all means. NeOnc Technologies Holdings has raised $5 million through convertible notes. The terms with the discount and conversion price suggest they're either in a growth phase where they need capital quickly and are willing to offer attractive terms to investors, or they might be facing some financial headwinds that necessitate this kind of financing. The significant discount and the conversion terms mean that existing shareholders could see their ownership stake diluted if the company's stock performs well. Investors are essentially betting on NeOnc's future success, and if that bet pays off, they'll benefit from converting their debt into equity at a favourable price. The potential for extensions on the maturity dates coupled with increasing discounts does raise a flag. It could indicate that management is anticipating needing more time to achieve certain milestones or to improve the company's financial position before the debt needs to be fully repaid or converted under favourable terms for the company. This is a strategy that can work if the company delivers, but it can become very costly if things don't go as planned. From a Warren Buffett perspective, you'd want to understand the underlying business. What's NeOnc's competitive advantage? What's their revenue model? How are their products or services performing? These convertible notes are a financial instrument, but they're a tool to fund operating business. Without understanding the strength of that business, it's hard to say if this financing is a sign of aggressive growth or a sign of desperation. The fact that these are from certain unaffiliated, accredited investors suggests they were likely private placements and not widely marketed to the general public, which is also typical for this type of financing. All in all, this filing tells us that NeOnc Technologies Holdings is actively managing its financing to support its operations. The terms of these convertible notes are aggressive from an investor's perspective, which could mean future dilution for current shareholders. It's a common tactic in the world of biotech and growth companies, but it comes with risks that investors need to be aware of. What's your take on these convertible notes? Do you think NeOnc made a smart move by getting this funding, or do the terms signal potential trouble ahead? Drop your thoughts in the comments below. I'm always curious to hear what you guys think. If you found this breakdown useful, please give it a thumbs up. It really helps the channel out. And of course, subscribe for more of these deep dives. Don't forget to check out the Discord in the description for more in-depth discussion. Thanks for watching, and I'll see you in the next one.